less than making over $600 in 1862, you might be a little upset. For the first time in American history, you'd have to take a percentage of your income and pay it to the federal government. The tax is simple: 3% on incomes between $600 and $10,000, and 5% tax on anything above to help pay for the Civil War. Today, in 2022, the landscape is a little different. 13 hours. That's the average tax filing time for an American citizen. Put differently, your significant other could watch the entire Star Wars trilogy, the original Star Wars trilogy, twice, and still have time to laugh at you as you try to find the receipt from Home Depot for the kitchen remodel that you're trying to write off. The tax code is a little longer than a few paragraphs today. Its estimated length is in the thousands of pages, that is, which would stack it all the way to the ceiling if it was sitting on your desk. That's complexity. And where there's complexity, unfortunately, there's often paralysis. But there can also be opportunity. And in this episode, I'm joined by Valerie Escobar to help walk through 5 tax planning strategies and opportunities.
Absolutely. It's good to talk to you, Mike.
Yeah.
Excited to bring these points to you, to our audience. And let's go ahead and dive in. And with our first one, the Roth conversion. What this strategy does is it moves money from your traditional IRA, take it out of the traditional, move it into your Roth. This will require that there's taxes paid. So don't get shocked when there's a big tax payment due at the end of the year. That's the point. But what it does is allows money to grow within that Roth and never be taxed again. So that's the beauty of the Roth conversion. What we want to do is time it during low income years. So maybe there's a gap year. Maybe you've retired. You haven't started Social Security yet. You haven't started your required minimum distributions. Those are the ideal years in which you want to do your Roth conversions. Mm-hmm. Another point is that to get the most bang for your buck is to not withhold taxes from the IRA distribution. So you can put you take out $10,000 from your IRA, put the whole $10,000 in your Roth. But don't forget there's taxes, of course. And so you need to plan on how you're going to pay for that liability outside of touching either of those accounts.
Mm-hmm. Yeah, I mean, you're exactly right. The gap years, right? Those maybe just for whatever reason, lower income years. And then again, sometimes there's that misconception that floats around that you have to convert the entire Roth IRA. Not always the case, right? You can convert whatever portion of it you'd like. But yeah, definitely, a highly effective strategy, something we model out for a lot of people. So the next strategy, Backdoor Roth IRA, is in a form a little bit of a Roth conversion as well. But, Backdoor Roth IRA, for whatever reason, it got this shady kind of slimy sounding name. It sounds like you're deceiving or being dishonest with the taxman. You're not. It's complete.
Although we're not really are that concerned about, trying to take advantage of the tax system.
Yeah.
So
yeah, I mean, obviously, if you see an advantage, there's tax planning and there's tax evasion. Those are obviously two different things, right?
Exactly.
And you want to be cognizant of a few different contingencies with this. But again, just to give you a quick overview on how it works. You contribute money first to a non-deductible IRA. You then move that money to a Roth IRA by way of conversion. This gets you around being phased out of a Roth IRA. So if you're maybe a high income earner and you've been phased out of just contributing to a Roth IRA, you can contribute to this non-deductible IRA, then convert it to a Roth IRA and kind of get around that issue. But again, I mentioned there's some contingencies here. Oddly enough, the taxman did figure out that there were high income earners who are maybe skating around some of these tax laws and getting money into the Roth IRA. And so one of these contingencies is the aggregate rule. So if you have any existing IRAs, simple IRAs, SEP IRAs, traditional IRAs, what they'll do is they'll look at a portion of your entire IRA portfolio and they'll say, okay, hey, part of that has to be taxed. It's called the aggregate rule. It's a little confusing, but again, if you have existing simples, SEPs, or traditional IRAs, you can be subjected to further taxation on this conversion. Normally what would happen is it's just post-tax money that you're contributing to this non-deductible IRA. You convert it over to this Roth IRA. There's no taxes if you didn't have any other existing IRAs. But if you did have existing IRAs, you might be subjecting yourself to some additional taxes on top of that. So obviously, a consideration there for anybody that's thinking about, hey, do I want to take advantage of this? But I would say, there's kind of a flow chart that maybe helps, because this does get a little complex as to whether or not you'd want to do it. If you're making less than the phase out amount for the Roth IRA, that is, you can just contribute to a Roth IRA. Why would you do this? You would just obviously contribute to the Roth IRA. So first, if you're below that phase out number for Roth IRAs, just contribute to a Roth IRA. There's no point in going through all this hassle. If you're above that, and you don't have any existing traditional SEPs or simples, this is obviously a tactic that likely makes sense to execute, and it likely makes sense to execute that conversion almost immediately after contributing to that non-deductible IRA. So some things to think about with it, Valerie.
Absolutely. Yeah. And, with our clients, we like to keep things as simple as possible. So another piece that we do is that we don't invest the non-deductible IRA contribution. We just let it sit at cash, then we can convert it. Therefore, there's no gains that are taxable either. So just something else to lower that CPA bill as well. So our next piece is asset location. So let's say we're going down the road. You've talked to your financial planner. You've decided that 5% rate of return is going to get you where you need to be to meet all your financial goals. And in order to get that 5%, we've decided a 60-40, plain old vanilla 60-40 allocation, where 60% goes to stocks, the other 40% is fixed income. So now where do we invest it? Where do we put this money? So we have our taxable accounts and we have our qualified accounts, which means tax shelter, our IRAs, or Roths. We can do it very simplistically in that we put that same 60-40 lineup of investments in all of those different accounts. But to get our little extra, out of our tax efficiency here, what we want to do is put our least tax efficient investments in our qualified tax sheltered accounts. So what's that, Michael? You want to know which are the investments that are least tax efficient?
That was the next piece. Yeah, go ahead.
So we're talking about anything that pays a dividend or has some kind of income. So bonds, they will have yield. That's the whole reason people buy them. We also are looking at real estate, REITs. Those will pay a yield, and even some of our stocks that pay our dividends. So those are those investments you want to put in those qualified buckets. And then at the top, where we're looking at real tax efficient, it's going to be stocks that are more growthy, and that we're looking at capital gains type of growth to go with that. So that's our taxable stuff. But again, consult with your financial advisor, just because it will put you in a situation where your taxable accounts are going to be the most aggressive. And if you are needing a second bucket to dip into for emergencies, you want to make sure you have a safe bucket as well. So just a caveat to add.
Yeah, I mean, obviously some great points there. And, there's all of these different tools, all of these different investments, these different assets, and they come with different taxation, right? So, I remember there was a Vanguard paper that actually came out in the past that talked about strategically positioning your assets and how that was a part of what's called the advisor alpha. So essentially, what percentage of just overall growth people missed out on because they maybe didn't have the right assets just in the right buckets. Not necessarily they were bad, they just maybe weren't in the right bucket, right? So definitely some things to think about there. Now, tax loss harvesting, point number 4 here. It sounds a lot better than the Backdoor Roth IRA. For whatever reason, it got the good name. It's got harvest.
Yes, farmers. We all love farmers. And
you hear harvest, you hear loss, right? I mean, Valerie's out there in Kansas. She feels good about it. She feels okay about it.
I give it my thumbs up.
Yeah. So tax loss harvesting is essentially the selling of securities at a loss to offset some gain, right? And you're limited on how much you can offset from a short-term standpoint each year at $3,000. But, effectively what you're doing here is a lot of times just deferring your taxable gain. Okay. So, a lot of times investors at the end of the year will maybe look to capture some of their losses. They'll go look at their portfolio and say, okay, hey, I got this stock at a loss. I got this stock at a loss. I'll sell those. I'll offset and sell some of my other stocks at a gain. A couple, pieces I think are worth noting here. So I've found that people tend to overestimate tax deferral. So the actual benefit of tax deferral, it is a benefit, right? But it's not that large of a benefit maybe as your perception might think. And I think part of the issue is, well, I'm not paying taxes today. That feels pretty good. So you feel like you're getting a very good benefit today. You're realizing that benefit today. But the reality is, if you stayed in the same tax bracket for the rest of your life, there wouldn't be as big of a benefit maybe as you might think. And, there's a couple different white papers that are written around this, but I would say that the real benefit here is if you do believe that you'll be in a future lower income bracket. So again, as Valerie touched on those gap years, right? So if you're maybe having an early retirement, you have a sabbatical, whatever it might be, you can then look to realize some of these gains that you've deferred in a low income year. And maybe you're in the 15% capital gains bracket when you do that. Maybe you're in the 0% capital gains bracket when you do that. So obviously that's a benefit. Now, again, if you just deferred for your whole life and you died, well, you get to step up in basis. So I guess that's a benefit too, but you're probably not banking on death as the main primary source of your strategy for this.
You don't usually implement death as
yeah.
our strategy.
Yeah. I mean, again, there's some contingencies that come with that, some considerations, but, again, I see it as something that if you believe you'll be in a lower income bracket in the future, it can maybe justify deferring some of those gains, which is essentially what a tax loss harvest is.
Yeah, so. Absolutely. And then we do, as planners, have a bad habit of making money for our clients. And while we want to de-risk and sell off some of those big gains, so that tax loss harvesting is perfect. It kind of gives us some tax credits. It's not actually a credit, but it's sort of a coupon that we can redeem for offsetting those capital gains taxes. Yeah.
And one last note on that too. You want to avoid wash sale. Sometimes, people can get caught up in this. But actually, I had a friend of mine that just said, I got this bill that says I don't get to write off a certain amount of my taxes this year, that I thought I was going to be able to do. So again, if you sell a substantially identical security within a 30-day period and go and buy it, the same stock, let's say, right? Or a substantially identical security, which would be like the same A share or an A share and a B share of the same mutual fund. You can get dinged with the wash sale rule, which means you just negated the whole strategy. So one last piece just to add on to that.
Yep. Agreed. All right. And while we're on that, talking about farmers and harvesting, let's talk about charitable giving and other things that make people feel good. Giving to charity is something that is not only beneficial to our society, but it can also help with our taxes. One of the simplest ways is called qualified charitable distributions. This is when you are over 72 and you are required to take minimum distributions from qualified accounts. So your IRAs, 401ks, things like that. That is required by the government. And the reason why is they don't want you to keep money in there forever. And they also want us to pay the taxes on it, right? But you can actually avoid paying those taxes if you give that required minimum distribution to a charity. So pretty easy way, you don't get to keep your money, but at least you avoided paying the taxes on it. And a second thing that you might do is if you're not quite 72, you can give to charities and count that as a deduction. But if you are itemizing, you need to have a certain amount to meet that threshold. And so to help with that is, let's say we're going to bunch our charitable gifts into one big year. And so, I know that you're big into the Hedgehog Society. And so you give a lot of money to them. And so instead of
big hedgehog,
yeah. And so those hedgehogs, they don't need $10,000 a year over 5 years. Let's just give them the $50,000 all in 1 year. And then therefore you'll get a lot more benefit out of it on your taxes.
Yeah. So grouping obviously those donations, and sometimes there's this fallacy that kind of exists out there. I know Valerie and I have talked about this, where you maybe think, well, I'm just avoiding all these taxes. I'm ending up at a net gain by donating to a charity. Unfortunately, that's not the case, right? So it's not like you can give all this money to a charity and walk away with more money, right? There's benefits in the way that you go about it, so you can essentially avoid more taxes strategically, but you're not ending up at a net gain by donating to a charity. Really, in almost virtually every situation that I've ever seen, right? So again, obviously some different things to think about here, some different strategies to help, obviously, with this complexity. You think about this tax code, thousands of pages in length. That typically means opportunity. So hopefully you found this helpful. As always, make sure to hit that subscribe button if you're listening on Apple Podcasts, Spotify, YouTube. Hit that subscribe button to follow along for more content from industry professionals here at Mariner Wealth Advisors.
Thank you for joining us on this episode of Your Life Simplified. We'll see you next time.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.